Hello and welcome to our 2020 Q3 Global ACS webcast. I'm Gary Berkowitz, a partner in our global accounting team, and today I'm joined by two of my fellow partners from the global team, Marie Kling and Scott Bandura. Now, our plan for the next 35 minutes or so is to focus our discussion on the issue that's most relevant to our stakeholders at the moment, that is accounting in times of uncertainties. The key uncertainties we want to primarily focus on today are, number one, the uncertainties linked to IBOR reform, and secondly, disclosure reminders due to the continued uncertainties linked to COVID-19. We'll also provide a few reminders on other areas that have come out of the IASB and the IFRIC. Please feel free to use the timestamps in the description below the video if you want to go straight to one of the topics that we're discussing today. So let's first kick off with the IBOR reform. The IASB has recently issued its IBOR reform phase 2 amendments, and I think Maria and Scott are going to cover this.
Yeah, thanks, Gary. So I'll do a little bit of an intro first, just on interest rate benchmark reform, and then we're going to dive into the specific phase 2 amendments. So as you know, right, following the financial crisis, the replacement of benchmark interest rates, such as LIBOR, right, was a priority for global regulators. And so in many jurisdictions, there's processes in place of transitioning to alternative benchmark rate. And really the aim there is to shift away from individual quotes to kind of observed trades, but also to increase the population on which those trades are based. Now, of course, as with any market-driven change, there still remains some uncertainty around the timing, but also the specifics of these changes. There's various transition target dates or milestones along the way, but the agreement by the contributing banks for LIBOR quotes ends on December 31st, 2021. Now, of course, the impact of the reforms really goes beyond accounting. There's also tax, systems, and legal impacts. So it's really key for entities to work on this sort of from a multidisciplinary perspective and appropriately capture all of these reforms. But our focus today will be on the accounting aspects. Now, given the pervasive nature of IBOR-based contracts, the reforms could really affect companies in all industries. Now, of course, banks, financial institutions are significantly impacted by IBOR reform, but many corporates will be impacted as well. That could be a corporate that has issued LIBOR-based debt, or even that has issued fixed-rate debt, but has hedged that back into a variable IBOR-based financing. But even lessees with lease payments that are indexed to an IBOR rate will also be impacted. So now, in order to ensure a smooth transition to the new rates, the IASB has undertaken a two-phase project to really consider what reliefs are needed from an accounting perspective. Now, as you remember, phase 1 was released in September 2019, and those amendments provided temporary relief from applying specific hedge accounting requirements and focusing on what we call the pre-replacement issues. And then just last month, in August 2020, the IASB concluded phase 2 of that project on benchmark reform and released an amendments to a number of standards. So what phase 2 really does is address issues that arise when an existing benchmark is now replaced with that new benchmark, that alternative reference rate. So that's what we call the replacement issues. Now, these phase 2 amendments are mandatory, and they're effective for periods beginning on or after January 1st, 2021. Early application is permitted, of course, taking into account any relevant endorsement considerations. So there's really a lot in those amendments. So I want to turn it over to Scott to walk us through the specifics of these amendments in a little more detail. So Scott, over to you.
Thanks, Marie. Well, let me first start out with the scope of the amendments, and then we'll go into the nature of the reliefs in a bit more detail. The amendments apply to changes that are required by benchmark reform. What does that mean in practice? Well, fundamentally, there are two conditions that need to be met. Firstly, that the change is necessary as a direct consequence of benchmark reform. And secondly, that the new basis for determining the contractual cash flows is economically equivalent to the old basis. So this could be replacing a benchmark rate with a different one and amending the spread to take into account the different credit risk profile of the new benchmark. Often, this will also include changes to interest rate reset periods. So where the new benchmark, for example, is an overnight rate versus previously the IBOR having a term rate. Adding fallback provisions, which specify in detail how and when the rate would transition, could be one way of affecting these changes. The concept of economic equivalence is intended to be principles-based, so the amendments do not include detailed application guidance. And the relief is not limited to any particular way of implementing the reform, provided it is part of market-wide reform of an interest rate benchmark reform that results from the recommendations set out by the Financial Stability Board back in 2014. What is the nature of these reliefs? Well, the Phase 2 amendments cover three key areas. Firstly, the changes to the contractual cash flows of financial assets and liabilities. Secondly, hedge accounting reliefs. And finally, disclosures. Marie, maybe you can walk us through some of these.
Thanks, Scott. I'm going to start with the changes to the contractual cash flows, so the easy part, and then I'll turn it back over to you to cover hedge accounting. So changes to contractual cash flows, what does that mean? So these changes apply to financial assets and liabilities, but also lease liabilities from a lessee's perspective. But let me start first with financial assets and liabilities. Essentially, what these amendments do is require entities to update the effective interest rates for changes in the basis for determining the contractual cash flows. So this is really akin to the accounting typically followed for movements in market rates. So it avoids the recognition of an immediate gain or loss and also does not result to an adjustment to the carrying amount. Now, if there's changes that are made in addition to the changes that are required by benchmark reform, these changes would not be eligible for the relief. So how does that work? Well, an entity would first have to update the effective interest rate for the changes required by IBOR reform, and then apply IFRS 9 to the other changes. So that means determining whether the recognition applies, or if not, apply modification accounting. So really, one has to be careful if there's other changes that are agreed upon during the negotiations with the different counterparties, for example, changes to the credit spread. Key to remember that only changes that are required as a direct consequence of the reform and that are also economically equivalent qualify for this relief. What about leases? Well, there's the similar relief for lessees under IFRS 16. So IFRS 16 was also amended to require lessees to use a similar practical expedient when accounting for lease modifications that change the basis for determining the future lease payments as a result of IBOR reform. So that could be, for example, where your lease payments are indexed to an IBOR rate. Now, there is a difference, though. If there are other changes made to the leases, then this two-step approach that I just mentioned for financial assets and liabilities is not applicable. If lease modifications are made in addition to those required by IBOR reform, then the applicable IFRS 16 requirement will need to be applied to account for all the modifications made at the same time, including those required by IBOR reform. And last but not least, the relief for financial assets and liabilities also applies to insurers who are still applying IAS 39, so who are not yet on IFRS 9. So that's it for the accounting for changes to contractual cash flows. So let's move on to the second bucket of amendments. Again, the changes to hedge accounting requirements. So let me turn it back over to Scott to cover the hedge accounting side.
Thanks, Marie. Yes, as usual, the hedge accounting amendments are a little bit more detailed and cumbersome to navigate. So let me try to cover the salient points here. On the left-hand side of this slide, you'll see items marked with a check mark, which are reliefs granted by the amendment. And on the right-hand side, the items marked with an X are items we want to point out which there is no relief granted. Let me start with the designation and documentation, and then I'll cover a couple of points around the accounting itself. So the amendments provide relief from certain hedge accounting requirements for changes to the designation required by interest rate benchmark reform. This means hedging relationships will not have to be discontinued solely because of the reform. Essentially, when the uncertainty associated with benchmark reform ceases, companies will need to amend their formal hedge documentation and designations to reflect those changes. A few key points on this. Firstly, this has to be done by the end of the reporting period in which the change occurs. So remember to plan ahead for this and not leave it to the last minute. Secondly, this can happen more than once, for example, because the changes affect the hedged item and the hedging instrument in different points at different points in time. So for example, the hedged item might be a bond, which changes to the new benchmark at a different time than the related interest rate swap. And finally, this does not result in discontinuation of the hedging relationship, which is one of the key elements of the relief. Again, the scope of these changes is important because if there are additional changes, that is, changes that weren't required by benchmark reform, and those changes trigger discontinuation of a hedging relationship, you need to apply the normal discontinuation guidance. It's also important to note that there's no exception from the measurement of the hedged item or of the hedging instrument. Because of the economically equivalent criterion, the expectation is the changes would not be significant. There's no exception from the measurement and recognition of ineffectiveness. The economic effects of the changes to the designation should be reflected in the income statement. So those are the key points from a designation perspective, but let me move on to a couple of accounting-specific considerations. Again, there are quite a few changes, and I can't go into detail on all of them, but did want to mention a couple of key ones. As you know, many entities are still applying IAS 39 hedge accounting requirements because they haven't yet transitioned to IFRS 9 hedging. For those entities, the reliefs provide an election to reset to zero the cumulative fair value changes of the hedged item and the hedging instruments, which will often help entities to effectively start fresh on their retrospective tests, and therefore, in many cases, will aid in remaining with the 80 to 125% effectiveness threshold and allow the continuation of hedge accounting. Risk components. So this is a bit of a complex area, but I'll do my best to explain it as simply as possible. Risk components typically apply in a fair value hedging relationship. And so say the hedged item might be a fixed rate bond, and the aim is to effectively convert that bond into a floating rate instrument. Both IAS 39 and IFRS 9 allow entities to designate only the risk-free component, the IBOR component, as the hedged risk in that fixed rate bond. This risk component needs to be separately identifiable and reliably measurable to be eligible for hedge accounting. Since the hedged bond is a fixed rate instrument, its cash flows are not directly impacted by benchmark reform. However, the fair value of the bond is impacted by benchmark reform, where market participants look to the new benchmark rate as an input to the fair value model. Under the Phase 2 amendment, such a risk component that is not separately identifiable is deemed to nonetheless meet the requirements if the entity reasonably expects to meet the requirement within 24 months of the date of designation, and that 24 months is hardwired into the standard. So a few key points there. So this approach applies to each benchmark rate separately. It starts from the date of the first designation. It applies to existing and new hedges, and it's only relief from the separately identifiable requirement, not from the reliably measurable one.
Thanks, Scott. That's certainly a lot for companies to think about in terms of hedge accounting. But as you said, right, the way I look at it, the objective is really to minimize disruption in accounting and allow many hedge relationships to continue, of course, with the appropriate recognition of ineffectiveness to the extent there is any. So let me move on to the next item, which is disclosures, and then, of course, transition. So from a disclosure perspective, the amendments really require companies to make additional disclosures on the effect of the reform, and that's to help investors understand how companies are managing the effects and all of the benchmark rate reform and also the associated risk. So the key disclosures are around the effect of benchmark rate reform on an entity's financial instrument and risk management strategy, how the entity is managing the transition to those alternative benchmarks, quantitative information about instruments that have yet to transition, and also changes to the risk management strategy as a result of the reform, to the extent, of course, there are any changes. So what about effective date and transition? So as I mentioned, the amendments are mandatory and they're effective for annual periods beginning on or after January 1st, 2021. These amendments are applied retrospectively. However, prior periods are not only restated if it's possible to do so without hindsight. And of course, new hedges can only be designated prospectively. Now, if hedges were discontinued, they would need to be reinstated provided certain conditions are met. And there's two conditions there. First of all, the hedges were discontinued solely because of benchmark reform and would not have been discontinued if the amendments had been applied at that time. And secondly, at the beginning of the reporting period in which the entity first applies the amendments, the discontinued relationship meets all the criteria for hedge accounting. So really, because of that, we do expect that most entities will want to adopt the phase 2 amendments as soon as they're able to do so. And that's really so that these reliefs are available when the changes do happen. And of course, taking into account your local endorsement rules in your jurisdiction. Because otherwise, what would happen, you may end up discontinuing hedges in one period only to have to reinstate them in the following period when the amendments are adopted. So that really covers what we wanted to discuss on the phase 2 amendments that were issued in August 2020. So I think we've covered a lot of material, so hopefully that was helpful. And I want to turn it back over to Gary now to cover some other changes.
So we've been focused on COVID-19 for most of this year's webcast material, but there have been some amendments to standards that we thought would make sense to highlight now. The IASB amendments have a mandatory effective date of 2022, but early adoption is available. Let me run through those amendments now. The first of which relates to IAS 16, our standard on property, plant, and equipment, and specifically it's an amendment that deals with the proceeds an entity might receive before an asset's intended use. Now, we may recall that IAS 16 requires that the cost of an asset includes any costs attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. Well, that's quite a mouthful, but those are the requirements in IAS 16. And one of those costs is testing whether the asset is functioning properly. And I think it's fair to say that there is diversity in practice as to how the costs of testing an asset are accounted for. Now, some entities choose to record both the cost of testing the asset and the related revenues against the carrying amount. So, for example, if an entity incurred $90 in costs to generate 100 of revenues during the testing phase, some entities will record the net gain of 10 as a reduction of the cost of the asset under construction. However, other entities might record revenue during the testing phase and record the related costs in P&L. So using my same numbers above, they would recognize $100 of revenue and $90 of expenses in the P&L. Now, the amendment to IAS 16 prohibits an entity from deducting any proceeds received during the testing phase from the cost of an item of PP&E. Instead, the costs of the items produced are dealt with in IAS 2, and that cost obviously won't include depreciation of the asset being tested because it's not ready for its intended use. And any proceeds that are received will be dealt with under IFRS 15 and be recognized as revenue. The second important point is that the amendment also clarifies that an entity is testing whether an asset is functioning properly when it assesses the technical and physical performance of the asset. Now, what's important here is that the board's clarified that the financial performance of the asset is not relevant to this assessment, and an asset might therefore be capable of operating as intended by management and subject to depreciation before it has achieved the level of operating performance expected by management. Now, this amendment could have a significant impact on entities that construct material items of property, plant, and equipment, and as part of that construction, there's a ramp-up period to test whether the asset is operating as it should. Now, a couple of obvious industries that might be impacted by the amendments are mining and industrial products industries. Management might need to introduce processes to track the cost of items sold and to account for an asset as ready for its intended use earlier than before. So although, as I mentioned before, the effective date is 2022, it might make sense to start thinking about some of those aspects sooner rather than later. Okay, let's move on to the second amendment that I wanted to talk about, which is one on IAS 37, our standard on provisions and onerous contracts, and specifically an item within IAS 37 relating to the cost of fulfilling a contract. Now, IAS 37 defines an onerous contract as one in which the unavoidable costs of meeting the entity's obligations exceed the economic benefits to be received under that contract. The amendment clarifies the meaning of unavoidable costs. And the amendment explains that the direct costs of fulfilling a contract comprises the incremental costs of fulfilling the contract. So, for example, the direct labor and the direct materials. But it clarifies that costs also comprise an allocation of the other costs that relate directly to fulfilling the contract. So the example there that's probably most relevant is an allocation of any depreciation charge for an item of property, plants, and equipment that's being used to fulfill a contract that may potentially be onerous. What's the result of this? Well, the amendment could result in the recognition of more onerous contract provisions because currently some entities only include the incremental costs in their assessment of the cost to fulfill a potentially onerous contract. I think what is worth noting, though, is if your current policy is to assess onerous contracts considering only the incremental costs, you don't need to change that approach until 2022, which is the effective date of the amendment. Again, however, it might make sense to start thinking about your processes and your systems to get you ready to assess all of your potentially new onerous contracts come 1 Jan 2022. Okay, so that's what came out of the IASB. A very quick update on the IFRS Interpretations Committee, or the IFRIC, and the tentative agenda decision relating to supply chain financing. The last time we mentioned that the Interpretations Committee discussions about supply chain financing and how disclosures will be key. And here we just wanted to give folks an update that the IFRIC has issued a tentative agenda decision and that it's open for comments until the end of September. So not much time left, but if it's important to you, you still have a little bit of time to comment. And just want to briefly explain that or highlight that the tentative agenda decision covers items such as the derecognition of any existing financial liability. It covers how it should be presented in the balance sheet. It covers presentation in the statement of cash flows. And the decision also covers disclosures that entities might want to think about and specific consideration of IFRS 7 in that regard. Now, in our prior webcasts, we focused on the areas of accounting most affected by the uncertainty of COVID-19. And we discussed some of the disclosure aspects impacting impairment of financial and non-financial assets, government grants, going concern, valuations, and income statement presentation, including alternative performance measures. So we've covered quite a bit. And if you're interested in those, please refer back to our April, May, and our June webcasts. Now, the key areas for disclosure continue to be around impairment for financial and non-financial assets. And so we thought we'd take a couple of minutes to provide some key reminders on these two aspects. We'll start by talking about impairment of non-financial assets. Now, we've seen some common themes around disclosures related to impairment while entities have been affected by the impact of COVID-19. And I'd maybe like to cover 5 key points here. My first is sensitivity disclosures and how they are really important in these uncertain times. So a reminder to cover all significant assumptions and provide sensitivities that are meaningful. So for example, at what level of change in assumptions would an impairment occur? Or how much would headroom be left at the bottom end of the range of assumptions? Now, this disclosure is critically important in today's environment because of the higher level of estimation uncertainty and judgment required to determine impairments in the current economic environment. The second point is ensuring consistency between forecasts in other parts of the annual reports and impairment assessment forecasts. We mentioned this in a past webcast, but again, to reiterate, because different functions in an organization might prepare different forecasts, the coordination and the communication between those different functions is key when it comes to preparing the financial statements. And if there do appear to be differences in the assumptions that are disclosed in the annual reports, it's important to be clear and explain why any difference in the assumptions is justified. My third point, for many entities, we would expect to see a widening of reasonably possible changes in key input assumptions. Because there'll be less certainty about the future, what is reasonable might be a broader range than in the past. And therefore, the disclosure should reflect this uncertainty by providing more information to users about how judgments and estimates may impact the financial statements. My fourth point is that entities should be focused on explaining holistically how COVID-19 has affected the entity's business, and therefore the specific financial statement line items, which may be subject to impairment risk in a clear, logical way. And here, tables might be helpful in this regard, but there really is no one size fits all. I think the key point is to the extent that COVID has not resulted in impairment indicators requiring a test, explanation of why this is the case might also be helpful. And I think here's what's also important is to think about your industry. So if you are in an industry which has been negatively impacted by COVID-19, but there are specifics related to your business which has helped you mitigate against that risk, explaining that to users would be incredibly helpful. My fifth and final point is updates from the most recent COVID-19 affected annual interim financial statements will also be something investors will be particularly interested in. I think we all know that IAS 34 and our standard on interim reporting is about bridging the gap between your most recent annual financial statements and your interim period. However, folks should also remember that there is a requirement if you've had material changes in your annual financial statements from your last interim period to also provide a little bit of disclosure around that to the extent that it's important for investors to understand the journey. And if we move to the impairment of financial assets, we've previously discussed how companies should think about adjusting the ECL models in light of COVID-19. Marie, do you want to maybe take us through what companies should focus on, please?
Sure. So let's switch gears to the expected credit loss model disclosures under IFRS 9. So, of course, we know that explaining and understanding expected credit loss disclosures under IFRS 9 can be quite challenging. And because of this increased uncertainty caused by COVID-19, financial statement users are actually expressing increased interest in those disclosures, and in particular, disclosures that tell the IFRS 9 expected credit loss story. Now, the disclosures are largely principles-based, so not prescriptive, and this may actually lead to diversity in disclosures in practice. And while we all agree there is no one-size-fits-all, there are, however, a few themes that I wanted to cover today that I think are relevant for financial institutions to really focus on telling that IFRS 9 story. Now, those themes relate to sort of the forward-looking information and judgment, second, model performance, but also model adjustments, and the third item is the disclosure of any significant changes. So let me start first with the first point around forward-looking information and judgment. Now, we know that in order to understand the forward-looking estimate, information about the inputs used and the judgments made about the future are actually key. Now, this includes disclosure of your forecasts of the key macroeconomic variables under multiple economic scenarios and the probability weights that have been assigned to each scenario, and maybe even what the resulting expected credit losses would be for each scenario before the probability weighting. What's really key is for a user to be able to understand the dynamics of changes in credit losses and their sensitivity to significant assumptions, including those that result from the application of those macroeconomic assumptions. Now, while I agree that it's certainly imperfect, a sensitivity analysis of these expected credit losses under multiple scenarios may be meaningful because it enables users to understand the uncertainty of the estimate and can provide a reasonable range of possible outcomes. In many cases, institutions provide the information in their annual reporting, but disclosure in interim financial statements is also likely to be warranted, particularly under the current uncertain conditions. Now, also, what's important is to discuss the interaction between the modeling used for expected credit losses and market inputs, such as the inputs used to disclose the fair value of your underlying financial assets or loans. For example, whether the widening of credit spreads in the market and the related probability of defaults have translated into expected credit losses for the related exposures. And last but not least, the consistency of these assumptions with market data and other areas of estimation in the financial statement is clearly an important area for users to understand. Let me move on to the second key point or second theme, and that's disclosure about model performance and model adjustments. Now, a key source of uncertainty in expected credit losses is model performance, and that particularly the need for model adjustments. Now, we all know that the models, the expected credit loss models, have been developed using historical data that looks different from the world today. And so adjustments, either to the model themselves or to their outputs, are actually often needed. Now, when adjustments are made, it's really important for disclosures to explain why and how the adjustments were made, and also what uncertainties remain. For example, some model adjustments may be made to reflect the impact of the government stimulus packages on credit losses. So these disclosures about model performance can be quantitative, i.e. what we call the over or underlay amount, or qualitative, or both quantitative and qualitative. On to the last point, the next theme, the last theme, that's discussing significant changes, and that's particularly important in an interim period. Now, we know that in almost all cases, the economic effects of the global pandemic represent significant changes, and frankly, the related uncertainties may be very substantial. So discussing those changes is really key. And frankly, that's particularly important for interim periods because interim financial statements provide an update of the information that was included in your previous annual financial statements. And so it presumes that readers will have access to those previous financial statements. So as a result, IAS 34 requires disclosures to focus on new activities, events, and circumstances that are significant to the understanding of the entity's financial position and performance since the end of that previous annual period. Now, all of these are really reasons to revisit existing disclosures. For example, the granularity of the information, any differentiations of allowances between your performing and non-performing loans, or any changes in ECL and expected credit losses, including write-offs. So it's really key to pay careful attention to what has changed in the current environment, and disclose that, such as changes in policies related to how client relief programs or even government relief programs are treated, take-up rates, or also any significant changes in processes relating to the quantification of your expected credit losses. So, but frankly, the issue is not limited to financial institutions. So corporates, of course, also have to provide disclosures. So I want to turn it back over to Scott to just give us a few reminders around disclosures in a corporate environment. So Scott, over to you.
Thanks, Marie. Well, as you know, IFRS 9 allows a provision matrix approach, which is a simplified model to be used to determine the expected credit loss for trade receivables. A provision matrix uses past data and forward-looking information to calculate the lifetime expected credit losses, and essentially applies an expected loss rate to every aging category of receivables, including the current category. So for entities applying the provision matrix approach, as Marie was mentioning, it's equally important that those entities tell the story of how the impacts of COVID-19 have been incorporated. So a few disclosure areas to focus on as a result of COVID-19. Firstly, how COVID-19 has been reflected in the inputs and assumptions used to measure the expected credit losses, including any forward-looking information, assumptions, and additional adjustments or overlays. Credit risk concentrations and stratification, and whether the approach has changed to reflect additional granularity, taking into account the different effect of COVID-19 on different receivables and industry sectors. So I often use the example of an entity that was selling to restaurants and to grocery stores. Previously, they may have grouped together those receivables because the risks were considered to be similar, but as a result of COVID-19, the risk profile of those customers may have changed and therefore warrants additional granularity. The carrying amount of the receivables that are credit impaired at the reporting date, such as receivables from debtors that are in significant financial difficulty or receivables that are more than 90 days past due, and also credit risk management practices and how these have changed due to COVID-19, including payment holidays, extended payment terms, or other reliefs granted to affected borrowers. Critical estimate disclosures. These could include disclosures about forward-looking information, how receivables have been grouped, or the determination of credit adjustments versus price concessions. Okay, back over to you, Gary.
Thanks, Scott and Marie. I think that completes our discussion for today. And wrapping up, I think I just have a couple of key messages. The first is on IBOR reform. I think it's important to remember that the IASB's changes are intended to make life easier and avoid disruption from an accounting perspective. You should consider early adoption of the amendments, obviously keeping in mind endorsements, and make sure you have an overall IBOR transition plan that goes beyond the pure accounting ramifications. Remember that taking advantage of the amendments, as Marie was saying, at the right time is key, so planning accordingly would be a good idea. The second key message is, for disclosures, the overarching objective is to tell a story to the readers of the financial statements that they can understand. Now, obviously, we have various minimum rules that need to be met, but don't forget to also take a step back, put yourself in the reader's shoes, and think about the clarity and understandability of what is being disclosed in the financials. We hope the webcast will help you as you navigate some of the key issues arising from the uncertainty created by IBOR reform and COVID-19. If you have further questions, we have various resources available. Please refer to the links in the description below. Thank you very much.